Let's continue our discussion of investment appraisal methods. The payback method, this is a very commonly used and also rather primitive method the candidate will be very well acquainted with. We don't have much to say about this. One can see here that even if the total cash flows of the two projects shown here, A and B, are equal to each other, the pattern of the cash flows are different, and therefore the payback method is looking at how fast the initial investment can be returned. And we can see here that with smaller initial cash flows in the early years and larger ones later on, it takes longer for the 40,000 to be returned to the investor. In fact, the payback comes at some point over 4 years, within the 5th year. In fact, let's just call this the 5th year. One can calculate in precise number of months. In the case B, the cash flows come quicker, and therefore we can see that after 3 years, in fact, the full amount is recovered. So advantages, as we said, it's easy to use the payback method, but it doesn't really take into account the time value of money in a sophisticated sort of way. It's just counting dollar for dollar the return of cash. However, it can be interesting in the sense of trying to see which project does actually one's basic or initial risk is covered in terms of time horizon. So if one is expecting to be investing in a very risky country, for example, that may experience a revolution or result in a total write-off of the investment, then one probably is going to be feeling more comfortable with a short-term payback project, say 2 years instead of one, which is 7 years. If the project is in Switzerland, well, then of course the payback has a dubious value in terms of investment appraisal. Now, for investment appraisal, we're looking at cash principally as being the determinant of value, and we want to track the cash. So timing is everything. We want to understand how fast we can get our cash back. And of course, the idea is to discount cash flows. In other words, dollars received in the future are worth less in today's money than if we received dollars immediately. The discounting process is the reverse of compounding. Everyone knows how to compound interest. For example, if we have $100 today and we were to invest it for a year, let's say at 10%, we would have $110 after 1 year. And if we reinvest the proceeds for 2 years, again at 10%, we would have about $121 of value after 2 years. Now, the process of discounting is doing the same kind of calculations, but in reverse. It's saying that if we were to receive $121 in 2 years, what is that worth to us in today's value, in today's money terms? Of course, we need to have an interest rate that we can operate with. So if we've compounded going forward with 10%, the way we would get back from $121 to $100 is to take 121 and divide it by 1.10 squared, because the squared refers to the 2 years that we are coming back to the present. So for the algebraically inclined, here are the formulas that are capturing this discounting process. And of course, one can see, therefore, that if we take $100 that would be received after 2 years and we discount it at 10%, it would be worth in today's money $82.6. Now, this is very valuable because for projects which have a whole string of future cash flows, we can operate on each cash flow in each year separately, and we can discount it back to a present value. We can express the value of a project with $1 number in today's money, and that actually is a good common denominator to be able to express the value of projects, so we can choose between projects and see which one will be the most beneficial to invest in. Here's another calculation made for a string of cash flows. We can see here that the cash flows in the future values $100, 100 goes up to 125, then it goes down to 105, and then it finishes up at 140. Here's the discounting process. We can see here, adjusted for the number of years for when each cash flow takes place. And the present value is simply the addition of all of these individual cash flows expressed in today's terms. The reader can verify that the present value, therefore, of these cash flows discounted at 10% is 426. Now, for the mathematically inclined, discounting and investment appraisal is actually great fun and actually very satisfying. If one were to receive a pension, for example, where all the cash flows in the future are equal to each other, then there are shortcut calculations that one can make using something called annuity tables, which permit one to take the value of the annuity, a single annuity, and to multiply it by an annuity factor so as to evaluate what a string of these cash flows will be. The total present value of $100 received in each of the next 5 years, we can see here this is year 1, 2, 3, 4, 5, when discounted to present value terms, in this case also at a discount of 10%, will be equal to 379. Now is the time to get a feel for these numbers. Please verify that you know what the impact will be if we were to increase the discount rate, for example, to 20%. Now, of course, we can't do the precise present value calculation in our heads, but we can at least say that if we were to discount these numbers more heavily at 20%, $100 discounted at 20% would have a present value today of less than $90.9. In fact, we can calculate that 100 divided by 1.20 is equal to $83.33. It's smaller. And if we would repeat this exercise for each of these years at a 20% discount rate, we would end up with a present value which would be less than 379. Okay, and finally, let's just talk about the net present value idea. The reason why we have net present value is that when we do investment calculations, typically we're starting in year 0 with an investment amount. In this case, $200 being invested, which will open the door to the possibility of achieving a series of cash flows in the future. Now, we've said that if we know the discount rate, in this case 10%, we can discount these cash flows to their present values, and we've already added together these future cash flows. The sum of the present values, we said you can check earlier in these notes, was 426. So the cash flows, the returns from the project, their present value is 426. In order to achieve this present value totaling 426, we are being invited to make an initial investment of $200. Does it make sense? Would we want to invest $200 to receive, in today's present value terms, 426? Plainly, yes. The difference here is 226, which is positive, and this is what we call net present value. A project that returns a positive net present value is a good project. It's worth investing in. Now, I leave it to the reader to test if these cash flows had been discounted not at 10%, as you see here, but had been discounted at 20%, can you determine what the net present value would be of this project if we were to be invited to invest today $200? So this stays the same, but the future cash flows to be derived from the project over the 5 years would need to be discounted because they're riskier than we presumed before and therefore deserve to be discounted at a higher discount rate. Would that lead to a positive or to a negative net present value?